Good morning, trading world. It is January 21st, 2022, and this is my pre-market outlook and technical analysis for day trading the SPY. Before I get into things this morning, I have a lot of questions and a lot of new people asking questions. So just to kind of explain what it is that I do here, one of the most important things for a trader is having a plan, then trading that plan. And that's what I do here. I give an actionable game plan that maps out the trading day so that you're prepared for profits. So if you haven't already, go ahead and hit that like and subscribe button so that you can start getting the morning's game plan each day. All right, now that that's out of the way, the title for today's outlook: correction thrown in. If you got the analogy from yesterday's pre-market, this scenario shouldn't have been far from your mind. A bit early, but on your mind. And today's title is a play on that analogy. So I gave the analogy of walking away from, the pool or the ocean, being too cold, and, you kind of psych yourself out to jump in. So you walk away, turn around, and take a running start and just jump in. That's exactly what happened yesterday. So the play on words, instead of, since it happened a day earlier than I was thinking, the correction on the title, or the play on the title, is being thrown in, or correction being thrown in. And that's exactly what we're headed to, a correction. So I'm going to try to address as many of the questions as I can this morning. So bear with me. I have a lot to push through, so I'm going to kind of move quickly. And one of the things I want to let you all know, I had to leave my trading desk. I had to leave the desk around 11 a.m. so I didn't get a chance to see everything play out live. So I came back to a lot of questions. All right. The good news is that we are getting close to a temporary bottom, and the next leg happens fast. The bad news is that it's a temporary bottom. You ask, how do I know? The easiest technical way to explain this is that fear was felt. Whenever the short-term VIX is above the longer-term VIX readings, this is a sign of capitulation. And we got just about maybe 1.35 away from that actually happening. It's not a set in stone number where we cross and then all is well and we go back to normal. It just lets us know that fear is here and right now. I'm going to have to go through a lot of different sets. And one of the ways that I keep up with this is that I have a comparison chart that I bring up every once in a while when we get to this situation. And it's, you have to knock the dust off of it because it's rare that I have to bring it out. But what we have here is the red line at the bottom is the short-term or 9-day VIX. And the yellow is the regular or 30-day VIX. And then you have the 3-month VIX and then the 6-month VIX. And so usually the way that I see or know that we have full capitulation is when the short-term VIX crosses above all of the other VIX readings. And that tells us that we're here. Trouble is right now, and everybody's scared and running and panicking. So we're not far from what may be a short-term bottom. Now, being that we haven't completely crossed over, I do expect tomorrow another push lower. However, if you've been listening to me for a while, you know I like explaining things using analogies. I often compare the market to a person running, and like a person running, the market has to build endurance, and it takes water breaks and so forth. In a marathon, usually a person will set specific intervals to take water breaks. Sometimes you get tired early and you need to take that break at the first interval that it's available, whether it's a quarter of the way through or halfway through. And then sometimes you hit a stride where you can push a little further past the mark, but eventually you take that water break. The market is the same way. We hit the first mark for a water break on the weekly time frame, but on the weekly we're at such a good pace, I guess the market felt it could run a little further. Next, I have a bullish bias slated for the month of January. And in order to accomplish that, it would mean we have to close above 474.96 on the SPY. It's not set in stone that it has to happen, but with 7 trading days left, that sets up for a great dead cat bounce to shoot for. So I'm not saying that we're going to close above 474. I'm just saying it kind of sets up, it all culminates to where at the end of this month, we get a great running start at a dead cat bounce. And that 474 is just a level to aim for. I'm not saying that we'll get there, but that is a level to aim for. All right. Looking at tomorrow, we have a bullish bias as well, which means we only have to close above 446.75 in order to be positive or have that bullish moment compared to the previous day. But for tomorrow, I am more interested in seeing if we can reach full capitulation first before believing a bounce could carry over. Everything is relative to the lens in which you view it. Most are looking for a bounce to happen based on an intraday time frame. But when you realize that the energy is with a higher time frame, now you realize what most are calling a bounce is just consolidation on a higher time frame. Now, getting to where we are now, Investopedia defines a correction as a decline of 10% from the highs. Now, for where we are on the SPY, we're only around 7 to 8% down from the high. So let's take a look at that. All right, we have the high here. 479.98, so we'll get as close as we can. And let's take a measure. It's right around 7.37%, give or take. Another thing that you want to take notice of is that we're right here at the 200-day moving average. That's what the thick purple line is. It is the 200-day moving average. So the SPY is at 7 or 8%. Let's take a look around the rest of the market and kind of compare, because Investopedia says that a decline of 10% is a correction. That's for a normal bull market. Now, what we've experienced the last 7 to 10 years, to me, is not a normal bull market. So, going around to the different markets, we have the Russell. The Russell is down around 17 to 18%. So the Russell is nearing what would be called a bear market. Investopedia definition of a bear market, I'm quoting. One definition of a bear market says markets are in bear territory when stocks on average fall at least 20% off their high. But 20% is an arbitrary number, just as 10% decline is an arbitrary benchmark for a correction. All right. So we see where IWM is, and looking at the NASDAQ is down 12 to 13%. The Dow is down 6 to 7% as well. So what that tells me is that the SPY has some catching up to do. So let me bring up the map of the SPY so we can kind of figure out where we are and where we're going. All right. I've been using this map setup, and so far I've been using, this is based on the 4-hour chart. And on the 4-hour chart, you can see we have a level here at 443 where this could be a resting period, an intraday resting period, where we can get some type of reflection off of. But as deep as we are now, I'm going to go to the daily, and on the daily, that puts us the next or the bottom of the current channel that we're in at 425 on the SPY. Now, let's take a look at something else. We just learned that a correction should be around 10%. We're only at 7, 8%. Let's go down to where that 10% would take us. And 10% would be somewhere around 431. %, could be around that 431 area. And at that point, that lets you know that we're in correction territory on the SPY. So earlier I just said that we have some catching up to do when it comes to everything else, because the NASDAQ is 2% away from being in a bear market. And this is where I think we're headed. We're headed for a deep bear market. And going back to the 4-hour, we should kind of line up. It may give us that heads up, and that's it. Right there on the 4-hour map, that 10% correction lines up with that 431 area, that last, the bottom channel on the 4-hour map. All right. I hope that answers a lot of questions. So now let's get into the key levels to watch for today and plan the day out. All right, here we have the key levels for today, starting on the support side. Jack support is going to be the 444 through 442 area. Queen support is going to be the 433 through 431 area. And King support is going to be 426 through 425 area. On the resistance side, we have Jack resistance at 448 through 450. And Queen resistance, we have 453 through 454 area. And King resistance, we have 457 through 460 area. And for those that are asking, the Jack, King, Queen thing is just a way of ranking decision areas as for their importance or strength of holding for that particular day. And when I say decision areas, it's the same as support and resistance. I just prefer saying decision area because that's an area where you need to watch and make a decision. It's not set in stone as to being a support or resistance level. This is an area where you need to watch your indicators or internals that much more to make a decision. All right, now that we have the resistance levels, it's key to remember that we looked up on the daily map the major channel that we're in. It spans between 453 on the top side all the way down to 425 on the daily. Now, let's get into the scenarios. All right, the first scenario that we want to be prepared for is going to be our trend day down type structure. It has a 40% probability of playing out today. And what happens on a trend day down is that we open gap down. And from the open, we get a relief pop to try to fill the gap back to the previous close, which is 446.75, which is represented by the blue line here. Once we get up here, it's not saying that we have to get all the way back to 446.75, but usually if it's a trend day, somewhere on or before we get to 446.75 or the previous close, we find resistance and we reverse and we hit the main trend for the day, which would be this downtrend, which would take us towards our queen support. The queen support is going to be key today, or for the next couple of days, depending on if we can reach it today. So we would hit that queen resistance or possibly the king resistance, and we would reach our midday chop. And usually the midday chop, we go sideways, and then we open up the second half of the day after lunch with a head fake down. We start off down thinking that we're going to resume the main trend of the morning, and then we get a reversal, bringing us back up into the closing for the day. That's on a normal downtrend day type structure. Don't be surprised if we have this day type structure and the actual head fake is not a fake today, and we continue down into closing. Again, that's the trend day structure. Scenario number 2 is our rounded reversal day type structure, or as I like to call it, the range day, because it is part trend day and part range day. One of the key ways or key things to look for on a rounded reversal day, it doesn't always happen, but a majority of the time on a rounded reversal day, is that whatever energy that we had before the opening bell, it continues through into the cash open. So if we're coming in already in a downtrend, that downtrend will continue. The other key thing to look for to recognize a rounded reversal day is that whether you're looking at volume or whether you're looking at your indicator, we should have a divergence that is seen after maybe the third bar in your intraday chart. If you're trading on a 5-minute chart, after about that third bar, start to look for divergence, where price action is moving down, but your indicator isn't quite following the strength of that downtrend. So we would see either a build or flatness here on your indicator, either flat or slight up as price action is moving down. And like I said, from maybe about the third bar on your intraday chart or 5-minute chart, you should start to see this divergence play out. And on this round reversal, we usually have a pretty strong downtrend right off the open, all the way down to what we would find as our midday chop, or usually the queen or queen or king support area. And we would usually reach that midday chop. And again, this area will be key, because you will see that as we chop sideways, you should be watching for that divergence where we have that slight uptick on your indicator, on volume, on your internals. This is a key sign that we're going to have that rounded reversal. And on a rounded reversal day, as you saw yesterday, we give just as much energy, like whatever energy we had coming down, the strength of that trend coming down, we get that same strength going back up, or maybe a little more. So that is scenario number 2, the rounded reversal. All right, our final scenario for the day is going to be the expansive range day. And just like with all the other scenarios, the high volatility conditions make it a bit harder to differentiate between the different day structures. But what's even worse with the range day is that there are so many different variations that could happen with the range day. So the key principle on any range day is that we usually establish some type of boundary. We establish a high boundary and a low boundary, and the key thing is that we usually chop back and forth in between. But with all the volatility, we have these expansive ranges where we establish a boundary and then we push the boundaries. So on scenario number 3, which is the lowest probability of the day, we could look to set a decision area or lower boundary headed towards the queen or king support. And then it could happen vice versa. I have the vice versa up, where we head up. And here's another factor that can help differentiate between a range day and a downtrend day, is that the previous close is always vital to both. And on a downtrend day, that previous close will act as resistance. On a range day, that previous close could be sliced through, and we could continue on up, as I have here, to our jack resistance level. That's going to be a key factor in differentiating between the expansive range day and the downtrend day structure. So those are the scenarios that we're preparing for. This is a guide to help you through the trading day. I know for me, it helps me so much more of having something physical to look at, to kind of compare once we're in the throes of action, and not just running around with your head cut it off, waiting for something to happen, but you're not sure what. So this is how we use this in game planning our trades for today, knowing what day structure we're headed for, and then from there knowing how to react once we figure out what day structure we're in. So that's it for today. I hope this helps. As always, we're in very volatile times, and more than anything else, as I say this all the time, please know and define your risk. And from there, profit will follow. Wishing you a successful trading day. Have a great one.